In July 2025, China did something huge. It dumped $25.7 billion in U.S. Treasuries in just 1 month. This wasn't a small adjustment or routine portfolio rebalancing. It was a deliberate, massive liquidation. Their total holdings dropped to the lowest level since December 2008, right in the middle of the global financial crisis. And it didn't stop there. Back in April 2025, right after Trump announced his Liberation Day tariffs, China sold another $8.2 billion in treasuries. In just a few months, they've liquidated over $54 billion. If this pace continues, we're looking at a staggering $300 billion annual selling rate. To put this in perspective, imagine your biggest business partner suddenly demanding cash instead of IOUs. That is what is happening on a global scale, and it is not just numbers on a page. This has serious consequences for your savings, your investments, and the value of every dollar in your wallet. But China isn't alone. In October 2025, BRICS nations, China, India, and Brazil dumped a combined $29 billion in U.S. Treasuries in just 1 month. This isn't random. We're seeing coordinated moves by nations representing nearly half the world's population. China's treasury holdings have plunged from $1.3 trillion in 2013 to just $757 billion in April. 2025 menos a 44% decline over 12 years. This isn't volatility, it's a strategic exit from dollar exposure. And while selling treasuries, these countries are simultaneously building alternatives to the dollar. There are 3 major initiatives. Bilateral trade agreements allowing nations to trade in their own currencies, cutting the dollar out. BRICS, cross-border payments, a messaging system to replace SWIFT, enabling transactions without the dollar. The BRICS grain exchange, where commodities like oil, wheat, and metals can be traded in local currencies. Why now? The driving force is what experts call the weaponized dollar doctrine. About 70% of global reserve managers now cite U.S. sanctions and political risk as the main reason to reduce dollar holdings. In other words, holding dollars is no longer just financial, it's political. Central banks have seen the consequences firsthand. Russia was cut off from SWIFT in 2022. Frozen dollar assets were used as leverage. The lesson for the rest of the world: holding dollars comes with risk. This shift has major implications for Americans. Foreign demand for treasuries has kept U.S. interest rates low for decades, benefiting homeowners, businesses, and the government. But as trust erodes, that safety net disappears. China isn't selling because they don't need dollars. They reselling because holding them has become risky. And every nation watching is asking, could we be next? This represents the most significant change in global monetary dynamics since the Bretton Woods system in 1944. And it's creating a dangerous scenario for the U.S. economy. Sanctions that seemed smart domestically have triggered global financial blowback. Countries aren't necessarily hostile, they're protecting themselves. Meanwhile, BRICS is building functioning infrastructure. The cross-border payment system allows direct transactions in local currencies, bypassing SWIFT entirely. The grain exchange enables commodity trades without generating dollar demand. These systems are resilient, redundant, and designed to resist sanctions. China's treasury selling is reactive. The April 2025 $8.2 billion dump came just weeks after Trump's tariffs. China is now using U.S. debt as a weapon, not just an investment. If this pace continues, China could offload $300 billion annually. This isn't gradual diversification, needs a controlled exit. Who's buying these treasuries? Increasingly, short-term traders, hedge funds, and opportunistic buyers, not the long-term holders that once stabilized U.S. debt markets. Japan and the UK hold large positions, but for different reasons. They're not strategic stabilizers like China used to be. The math is clear. If foreign demand falls, bond yields rise, and borrowing costs for the U.S. government increase, with $37 trillion in federal debt. Even a 1% rise in interest rates adds $370 billion in annual debt service, more than we spend on veterans or education. This creates a self-reinforcing doom loop. Higher yields, bigger deficits, more borrowing, higher yields again. And meanwhile, foreign holders dumping dollars back into the U.S. expand the domestic money supply, fueling inflation and eroding purchasing power. The Federal Reserve faces an impossible choice: raise rates to defend the dollar and crash the domestic economy, or accept a decline in reserve status and risk runaway inflation. Either scenario is painful. So what should you do? Diversify assets. Precious metals, real assets, and select foreign investments can protect against a weakening dollar. Manage debt. Lock in fixed rates. Now variable rates are risky if interest rates spike. Watch indicators. Treasury reports, BRICS pay adoption, and IMF reserve data reveal acceleration in dollar decline. Understand politics. Expect potential U.S. measures to defend the dollar, including sanctions or restrictions on offshore investments. For 80 years, the dollar's dominance fueled American prosperity's heap borrowing, affordable imports, and global economic influence. But every privilege has limits. China has $54 billion sell-off ISNT. A reaction to tariffs, the start of a global realignment. BRICS doesn't need to replace the dollar overnight. They only need to make it optional. Each country reducing dollar dependence chips away at U.S. financial influence. History shows no reserve currency lasts forever. Spain, the Netherlands, Britain all learned that lesson. The math doesn't lie. Between now and 2027, decisions will be made that could shape the U.S. economy for decades. Awareness and preparation are key. The financial ground beneath us is shifting, and the consequences will soon be impossible to ignore.